The budget may have been and gone, and the number of FTSE 100 firms with scheduled news drops to just 3 in the week ahead, but there's still plenty going on. The results of the latest Bank of England stress tests of 7 major high street banks and building societies are due for release on Tuesday the 28th of November, when FTSE 100 firm Ferguson, Wolsey as it was, will also host its annual general meeting. Now, last year's bank stress tests worked on the basis of a UK property crash, a major slowdown in China, and a hefty 1.9% fall in global GDP. Lloyds, HSBC, Santander and Nationwide all passed. Barclays and Standard Chartered were judged to have enough capital to protect themselves and their customers, even if they didn't pass every test. RBS was the one name to fail, as review asserted that the bank needed an extra £2 billion in capital buffers. Since then, RBS has come to an agreement on its ownership of Williams & Glyn, settled one of 2 remaining lawsuits related to mis-selling of mortgage-backed securities in the US, and targeted a profit for 2018. So let's see how it does this time. The shares certainly think RBS fortunes are improving if this chart's any guide, and a clean bill of health plus a settlement of the 3rd lawsuit from the US Department of Justice could pave the way for the UK government to start selling down its 71% stake in the bank. Wednesday the 29th will bring results from a number of FTSE 250 firms, including fizzy drink specialist Britvic, water utility Pennon and acquisitive plastics packaging group RPC. On Thursday the 30th, FTSE 100 life insurer Aviva hosts an analysts meeting, transport group Go Ahead releases a trading statement, and consultants GfK will release their latest UK consumer confidence figure, which could provide an early steer on how Christmas may pan out for the retailers. The GfK reading dipped by 1 point to -10 in October, as this graphic shows. However, the biggest potential source of fuss in the week ahead for me is the latest meeting of the oil cartel OPEC members in Vienna on Thursday the 30th of November. Exactly a year ago, OPEC surprised a lot of people by agreeing to cut its output by 1.2 million barrels of oil a day to around 32.5 million, with Saudi Arabia leading the way. Non-OPEC members, spearheaded by Russia, then joined in last December by trimming their output by some 0.6 million barrels a day. The two moves combined removed around 2% from global daily production, and to most people's surprise, including mine I should say, OPEC and Russia have stuck to the agreement. They even extended it for 9 months to March 2018 back in the spring, and this has been a factor in the oil prices recovery back to around the $60 a barrel mark. Here's the price of Brent crude since last November's OPEC meeting. So, when it comes to assessing the news from Vienna on the 30th, the 3 things to look for in the communiqué are comments on production and the year-old cuts to 32.5 million barrels a day, any comments on the timeline and whether it will be extended beyond next March, and any pointers on the intentions of non-OPEC members, particularly Russia, which reduced its output by some 300,000 barrels a day, or around half of the total non-OPEC cut. Now this is important because supply-side restraint does seem to be the key to the oil price. Figures from the International Energy Agency show that demand continues to grow, albeit relatively slowly. One big wild card remains US shale output, which is currently some 6 million barrels a day, and big increases here could unravel OPEC's good work, and there has been a noticeable increase in production of late, no doubt encouraged by higher oil prices. One final point on oil is how the share prices of the big majors have responded to the latest rally, since both BP and Shell are trading pretty close to 5-year highs. If oil stays where it is, or goes higher for any reason, OPEC related or not, then the safer their dividends become, and both Shell and BP are among the 10 highest yielding stocks in the FTSE 100 right now. However, there remains that word, if, as oil has proved consistently unpredictable over time, although at least BP and Shell proved with their 3rd quarter numbers that they could make a profit and generate enough free cash flow to cover their own dividend payments even when oil was down at $50 a barrel. Thank you for watching, and I look forward to seeing you next time.